You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. Hello, welcome to the Savings Tip Jar. Great to have your company once again for episode 157 as we take a break from all the exciting football happening with the World Cup to talk finance, which can be just as exciting. Sometimes, maybe. And help you kick some money goals this year. Sorry, I had to make that link somehow. I'm Dom Beattie, the editor of Savings.com.au and a big football fan, in case that wasn't obvious, alongside our senior finance journo, Denise Raywood. And this week we'll be discussing the RBA governor's strong language following the central bank's decision to hold the cash rate. Does that leave the door open for another hike, or is it just jaw-boning? Also, mortgage demand has plummeted off a cliff, particularly for first home buyers, according to new data from Equifax. We revealed the shocking numbers. Plus, new research on Australians going through a divorce or separation reveals that around half of them end up taking on new debt. We break down some of the other interesting data points from that research. Then, for our Dollar Dialogue segment, we'll talk to Domain's Chief Residential Economist, Dr Nicola Powell, who has some fascinating insights into the current dynamics between the cash rate, the housing market, and the broader economy as well, and a great savings tip to boot. Don't miss that chat, but first let's check in with my terrific co-host Denise. How are you?
Yeah, good today, Dom. Very good.
That's the way. What's your savings tip for me this week?
Well, mine's just a simple, very old school one that, everyone's grandparents probably still do or should do, and that's just use something until it breaks. Just until it doesn't work anymore, until it's torn, until it's ready for the rubbish bin. Just use it until you can't use it anymore. And, that takes all the variables of fashionability out of it. Just feeling like you deserve something new. It just shouldn't be your priority. If it's still going, just keep using it. And this is from someone that has an iPhone 9.
There you go. Yeah, that is a good one. And I feel like probably there are a lot of people that do it that way. And I think that's why maybe some manufacturers have cottoned onto that and thought, hey, we can make more sales if we make our product essentially only last a couple of years. I feel like that's the case with a lot of phones that always seem to conk out or have significant issues after about 2 years or so, and then you're just somewhat forced to get a new phone. And that actually just happened with me quite recently. Yeah. In my household, where my partner, her phone has she basically got texted by her telco provider saying, hey, just so you know, your phone actually isn't going to function. You won't be able to make calls or anything anymore from June. And then we kind of sort of thought they were bluffing, and we thought, oh, yeah, sure. And then, of course, it actually isn't working. So we've had to go out and get a new phone. It's ridiculous. But then you also hear about those old school, washing machines from yesteryear and how they're still going 50 years later. It doesn't seem to be the case often with a lot of modern goods. Is that what you find, Denise?
Definitely. I did have an old washing machine, and it was the same bloke, the same old guy that I used to get to come and repair it, and it actually used a fan belt, and that was its main issue. So it was actually just this piece of rubber that he would put in for me, and, it was in the days when I had all the kids at home and there was just washing galore, and he would keep assuring me that, it would still have some years left in it. And he was right. As long as I got him to come and fix it, I think no one else would have touched it. Yeah,
nice. Well, I think that's the case these days. People can't be bothered repairing something. They just go, oh, what's the cost of repair? Or what's the cost of getting a new one? Oh, it's only a little bit more. I might as well just buy a new dishwasher. I feel like that seems to be the case.
Oh, so true. Yeah.
Yeah. But I do sometimes see there are some campaigns by people to encourage people to repair goods rather than get new ones, because of course it's probably better for the environment that way as well.
For sure. Just think of all that waste out there.
Yeah, a lot of stuff just goes to landfill, doesn't it?
Just overconsumption.
That's it. My savings tip this week is, I just need to remind myself, what is it? Oh, yes, gift vouchers. Don't forget about them. I found out just recently, I was sort of digging through some drawers, and I found there was a Maya voucher that was given to us Christmas time. and it was a $200 voucher. I was like, oh, well, that's hugely generous. Who got us that? I couldn't even remember. I've got my suspicions. I'm pretty sure I know who it is. My savings tip is, don't forget about these ones. So make sure you keep them safe and stored in the same place where you know where they all are, rather than scattered in different parts of the house. And keep on top of their expiration dates. There's nothing worse than finding an old gift voucher, particularly one that's worth a bit of money, and seeing that it's actually expired. Although I think, sometimes I think the expiration date thing is a bit of a con.
They did change the legislation.
Yeah, I think it's a bit of a law change, right? That they actually can't let them expire. They have to be so, but still, you could easily lose these gift vouchers or totally forget about them and never take advantage of them. Some things I find, like the experience vouchers, those, they have an expiration date, but, the thing is, even if you use it up within the expiration date, there's every chance that experience isn't available anymore. And you might lose out on that experience. You still get the value of that experience, though. You can exchange it for something else, like on Red Balloon. That's something we've done. But it is still worth keeping in mind, particularly if it was an experience that you really did want to utilize. So just keep all your gift vouchers all stored in the same drawer, or in a folder. If it's an e-voucher, those can be easily lost in our inboxes. I don't know about you guys, I have like thousands and thousands, tens of thousands probably even, of unread emails. They often get auto-categorized as promotional. With those gift card vouchers, make sure you put them in a special folder in your inbox, or you flag or label it or star it or whatever your email provider offers. Just so that it's easily found and you don't forget about that email. So, that's my savings tip.
Well, I've got something to add to that. When I saw that was what you were thinking of having as your tip, I actually just went to see, is there any data on how much Australians waste on, unused vouchers? And they say it's $1.25 to $1.4 billion every year in unused gift vouchers. And so that's about $200 wasted credit for every person. So that is a great tip. Yeah. That's incredible. Be organised. Actually,
I could somewhat believe that. That sometimes you'll purchase an item on a gift voucher and there might only be like, $1, $2, or $3 left on the gift card. You kind of just think, what's the point of this anymore? But no, that's still money. That's still, that $200 gift card. We ended up doing. I ended up buying a really, really nice jumper because I've been wanting one for years to keep me warm on those long train journeys up from the Gold Coast to Brisbane. And it was $199. It sometimes annoys me that some things are priced that way. Just price it $200. And it meant that I've got $1 left on that card. And I was like looking for other things to buy from Maya.
It's not
so that it wasn't anything left on it. And I was thinking, do I buy this stupid little little tiny bowl or ramekin or whatever that's like $2 from Maya, just so there's nothing left on it? I couldn't find anything worth buying, so I've just kept the card just with $1 on it. And I just thought, let's not throw this card out. There's still money that could be used to something. So I just made sure I wrote.
That is a very Scottish dilemma that you faced right there, I have to say.
Well, I'm guilty of it. I'm pretty sure there was a JB Hi-Fi voucher I've got somewhere that's got $1.40 or something on it, ridiculous, that I just thought, what's the point of that? I'll just not use that.
It's not surprising me, but it's good to hear.
Yeah, but that's crazy though. $1 billion that is going to waste on unused vouchers. All right, let's get into the Savings News Roundup, the big news of the week so far. I'll start us off, Denise, with the one that happened yesterday. It wasn't a huge surprise, the cash rate decision to hold. But it is nice for mortgage holders, I suppose, after 3 consecutive cash rate increases to kick off 2026. The RBA has delivered I think it's the first hold of the year, keeping the cash rate at 4.35%. But what was interesting, and many commentators noticed this, and noted this, the hawkish nature of the RBA Governor Michelle Bullock in her comments accompanying the decision, but also speaking to the press in her mandatory press conference afterwards, particularly saying inflation still remained too high and reiterating that Monetary Policy Board would further increase the cash rate if inflation remained at elevated levels. You listened to the entire press conference, Denise. What did you make of her commentary and her rhetoric?
Yes, the same sort of matter-of-fact tone, but yeah, just reminding everyone, because there does seem to have been a bit of a groundswell of opinion that the fact that this was likely to be a hold this week, this was the signal that, the upward cycle's ending and the next rate move will be down. There was quite a few economists that jumped on that bandwagon, and I think she just reminded everyone that inflation is still very high. And I guess we've seen and they did remind us in the document accompanying the RBA decision that it's early days in the US and Iran peace agreement. That may have taken a bit of pressure off and certainly would have been discussed in the RBA meeting, that the geopolitical situation was perhaps looking a little more optimistic than at the last meeting. But at the end of the day, fuel prices maybe haven't trickled through to other goods and services in the economy as they'd been expecting or as they are expecting. There'd be some easing of that pressure. But we get an inflation reading, CPI reading next week. And that will be interesting to see how that one stacks up. Of course, the previous inflation reading we had, it did reflect that the federal government had reduced the excise tax on fuel. So it will be interesting to see how the next one goes. And I don't think it's going to be low. So I think Michelle Bullock was at pains to remind everyone that we're still grappling with inflation in the economy. Things are softer and things are slower, but inflation, as far as the data shows, is still there.
Not out of the woods yet, for sure. Now, you've seen a story come through by a credit reporting agency on mortgage demand.
Yes,
Can you tell us through this one?
Yeah, quite interesting. It was figures for the month of May, and they came from Equifax, which is one of our big credit reporting agencies. And of course, they keep data, this very useful information on just demand for home loans, interest for home loans, how much work they've had to do. They have said that new mortgages, according to their data, dropped by 6.6% in May compared to May last year, with first home buyer mortgages plunging by 9.1% over the same period. And that's, quite a hefty downturn. There was a bit of a slowing in the previous month, April, but the figures really just did fall off a cliff in May. And of course, that's sort of reflecting we would have had 3 interest rate hikes by then. That affects serviceability and access to cash. But we also had in the federal budget just changes to housing tax. And you could suspect that a lot of investors didn't follow up with any interest in investing in property straight away, with negative gearing and capital gains tax goalposts changing. So, quite a marked effect. That will have quite a bit of an effect on our lenders and our big banks. It'll be interesting to see how that plays out in the broader economy. But yes, very interesting research, and I guess it's something that we all could see happening. There's a lot of information that the housing market has sort of hit a bit of a wall, and those figures certainly back it up.
Yeah, it makes sense, doesn't it? 3 cash rate hikes in a row are going to have an impact, particularly on that front line, at the coalface, the mortgages. People just probably can't afford to borrow, or their borrowing powers would have taken a substantial hit, particularly first-time buyers, and wouldn't be able to buy those homes. Even though in that same month of May there were reportedly sharp drops in property prices in Sydney and Melbourne, and probably maybe that's a result of the reduced mortgage activity, fewer people taking out mortgages, fewer buyers on the market. Naturally, is going to result in less property demand. Moving on to our final story in this Savings News Roundup. New research has revealed that at least one partner in a separating couple is likely to take on new debt from the split, with 1 in 5 carrying more than $20,000 in debt from a relationship breakdown, which is quite scary to hear. This is new research commissioned by Real Insurance that surveyed more than 1,200 separated Australians. It also found that almost half made quiet financial moves before splitting, with women more likely than men to build personal savings without telling their partner. That was 22% of women versus 13% of men. And also around 40% said financial pressures had delayed their separation, with 42% of separating couples reporting that they were forced to remain living together because they couldn't afford to live separately. That one doesn't come as a huge surprise. I think I've heard that before, that it is expensive. Divorces are tough, particularly these days when we live in such a dual income society. Particularly when it comes to housing, it's really hard to afford to buy a freestanding house, if you're not in a relationship with two incomes coming in, it's a lot of, to a certain extent, and I think a lot of our elevated housing prices these days compared to, say, in the 70s or 80s, is because the dual incomes are the norm now. What do you think about that one, Denise?
Yeah, that's quite interesting data. So I'd urge people to just have a bit of a look at that story. It definitely made sense. All the people that were surveyed were people who had divorced or separated, and it was just some of the demographic breakdown as well was quite interesting. I think poor old Gen Y, seeing the 30 to 45-year-olds, they've probably got a couple of kids in the mix there as well. They seem to particularly be hit hard by just the financial difficulties of relationship breakdown and divorce, and, a lot of emotional, it wasn't all just about finances. That's mainly what they concentrated on, but they did note that, there's a lot of emotional, issues as well that come up. So, it's worth having a look at that. But, it's you've got to think carefully about it, and there is some advice if you look at that story from a legal professional that specialises in separations and divorces, and there is a more economically and financially sustainable way to do it. And the secret, she says, is to get in early. And if you can see that this is, don't do the she'll be right. And that's something that they did note in the survey, that Aussies tend to have a she'll be right attitude, and don't get in and organise these relationship breakdowns, and it can be very expensive and very painful. So, if you're in that situation, I'd definitely recommend having a look at that story and some of the advice that goes with it.
Oh, yeah, for sure. There was one thing that also caught my eye in that story was the average cost of separation was reported at more than $18,000, and that includes legal fees, asset division, mediation, and other professional advice and costs associated with divorce filing and services. So, that sounds about right, particularly, and it aligns with the debt, the $20,000 in debt that 1 in 5 were carrying as a result of a relationship breakdown. So that's probably why people are actually having to go into debt to pay for their separation and divorce. So, it's certainly not an easy topic to talk about, but it happens. It happens so often. I never know what the exact percentages of, like, what percentage of
it's hard
relationships
to find that,
and marriages end in divorce or separation. So, but I think it is quite a lot, and maybe sometimes a lot of people don't want to talk about it because it's a bit of a depressing topic. But it is the reality, and a lot of people do probably need advice in that space. So certainly check out that article and seek support if needed. All right, I think that rounds out the main money matters for this week. Now it's time to talk to our guest for this week's episode. Okay, time for our Dollar Dialogue segment. And this week we're going to focus a little more on the RBA cash rate, but also its impact on the housing market lately. And for that, we're joined by Dr Nicola Powell, who's the Chief Residential Economist at Domain. Nicola, welcome to the Savings Tip Jar.
Hello.
Hi, Nicola. Great to have you with us. Now, before we get into everything Reserve Bank and housing market, have you got a generic savings tip for us?
I absolutely do. So mine's the 24-hour rule for anything that is a non-essential purchase. So before you go into buying anything that's, say, over $50, wait 24 hours, because what you will find is impulse buys rarely survive a good night's sleep in that kind of 24-hour period. So you'll be surprised how much you save, and I think we're all very much guilty of those impulse buys.
Great tip, Denise. We'll put that one in the jar. Yeah, I haven't heard that one on this podcast before. We've been running this for probably about 4 years, I think, now. So I'm surprised no one's ever said that. But yeah, that's a great tip, particularly for those that do often suffer from buyer's regret. That's not really me. I'm, quite stingy, and if any purchase over $50, I'm often agonizing about for weeks, and eventually I just go, oh, okay, just do it, buy it. But yeah, certainly for others that have no hesitation, that 24-hour waiting period could certainly do the trick. So the RBA decision to hold wasn't a surprising one. Obviously, no one was expecting much of a change. But what did you make of Bullock's hawkish tone? Like, was it a classic case of jaw burning there?
Look, it did have that kind of hawkish undertone, and I wonder whether partly it's kind of trying to rein in the real large conversation that has morphed over the last, say, 10 days around the next move from the RBA will be downwards. So I think there's an element of that playing out. And it was, as you mentioned, it was absolutely unanimous. I would be very shocked if they had moved anyway other than a hold. And I think what we're starting to see is the impacts of those 3 rate hikes already this year. It's starting to slow down the economy. And I think this kind of watch, wait and see approach is going to be something that the RBA adopts. And I'm still not even forecasting another rate hike from them this year.
Interesting. Now, we're going to discuss that at length further, but, as far as your expert area, which is the housing market, we have seen that, very soft, it's fair to say, just probably since the federal budget, but definitely the 3 rate hikes have fed into that. So what will this hold? Will it have any immediate effect? Is this going to do anything to the housing market, do you think?
Look, I don't think so. I think we definitely have got cooling momentum across our housing markets, and Sydney and Melbourne are feeling the brunt of that. Now, we've had 3 rate hikes. That's decreased borrowing power by roughly 7-8% ballpark, and that is having an impact. But we've got to remember we've had 3 rate hikes. We've also had a budget that has been delivered that wasn't very welcome in terms of those taxation changes that are proposed for housing. And, we're expecting those to actually get through the Senate. That is going to have an impact. We've got to remember that these changes are also happening at a time when Australians are feeling fragile, that we have very fragile confidence out there, and that has a marked impact on transactional activity. So everything is slowing down, and it was really interesting. We were seeing the rate hikes impact momentum in our housing market even before the budget. But then do you remember back in April where we were being drip fed this kind of leaks from the budget? We were already kind of seeing behaviours start to change. And this is one of the beautiful dynamics of our housing market that I find absolutely fascinating, is how confidence affects behaviour and decisions to buy and sell property. And what you'd find is when you go through a period of fragile confidence, people pause. They wait because they want more clarity and they want certainty. And we're in an uncertain period at the moment. And so, inflation isn't under control. We may have unemployment rising, employment dropping, GDP is weak, our housing market is slowing. So I do think what we're likely to continue to see is still weak momentum for Australia's housing market, irrespective of the fact that we've seen that pause from the RBA.
Yeah, that makes a lot of sense, Nicola, particularly what you say about the uncertainty, how that plays into housing market, because you really do have to be quite confident when you are making a housing purchase, because it is such a large sum of money that you're handing over. And so you want to be confident in your decision. You don't want to be having too many doubts, although that can be quite natural. But yeah, just touching on that a little bit more there. You mentioned how there was some talks of cuts that had surfaced, and maybe that was why Bullock had that strong tone in the announcement and in what she said in the press conference. But I wonder if there was a bit of a coincidence that those sort of talks of cuts surfaced right around the time just after we'd seen those property price results showing sharp drops, particularly in Sydney and Melbourne. I wonder if that sort of played into that. There's a bit of a social media narrative that plays out in the RBA, the banks, the government, they're all there just to prop up the housing market and keep the bubble expanding. I wonder, is there much truth to that sort of that narrative / conspiracy?
Absolutely not. They're really based upon data. I think that is just ultimate clickbait on social media. They're driven by data. And I think what's really interesting is the economy is slowing. We've got employment falling. We've got unemployment rising. Consumption, so household spending is starting to ease, and as you rightly pointed out, house prices are falling, and we've got extraordinarily weak clearance rates. When you add all of that up together, normally that is a signal for the RBA to start decreasing the cash rate. And I think that's where probably part of that conversation around cash rate cuts did come from. But ultimately, inflation is still too high. And those cash rate cuts are not going to be in 2026. When you look at the market pricing, you've still got market pricing in roughly a 50% chance of a rate hike in August. I think I am more in the camp of, I think we're going to see a period of hold. We will see rate cuts, but they won't come through until the latter part of 2027. I think what the RBA want to see is, have they done enough to tame inflation? And we've got to remember that rate movements behave in a lagged nature. So they're only just starting to see the impacts of some of those rate hikes coming through. And that last rate hike, we wouldn't be feeling that impact now. And then, of course, we've got the proposed deal for the Strait of Hormuz to be opened. And that's obviously going to take a little bit of pressure off the secondary impacts that are coming through in terms of the increased costs associated with fuel. So all of the things are kind of pointing in the right direction. But I think we are definitely just going to see a very poised manner from the RBA, and that poised manner is going to be a wait and see.
Yeah, that's probably exactly how I think definitely the RBA governor, who I'm always quite impressed with in her media conferences, how measured and data-driven she is, and I take my hat off to how well she handles all the media scrum there. But for the punters that listen to us, our regular listeners, those that are sort of, tiptoeing around the property market, and that'll include people who've been affected also by the housing tax changes. Let's just have a look at the next 6 to 12 months, say in that period before we see these rates coming down, if indeed they do. Who do you expect to be sort of, buying, selling, holding? What's the general advice for people who are, really in that wait and see? And it seems like a lot of people are in it.
Yeah, and I think that this is quite a poignant time when we go into dynamics like this where property prices are falling, we've got slowing momentum, because people feel very uncertain and unclear of what it means for them. And particularly if you've had a valuation for your home maybe earlier in the year and then you're getting another valuation and it's much lower, and often can be, tens of thousands of dollars. I mean, this is significant amounts of money. I mean, we've got to remember 70% of Australia's household wealth is tied to the value of our homes. That is a massive impact on people's wealth position. I think, my advice is, and look, this isn't meant to sound corny, but it is about making the decision that's right for you. I live and breathe our housing market. It is part of everyday pulse, even at the weekend for me. And it's very hard to time the market precisely. And as human beings, we want to sell at the peak and buy at the bottom. Very, very hard to actually time and transact in that type of dynamic. I think if I was a buyer at the moment, I would be very much utilising the lift in supply as my power of negotiation. Listings are rising. We're expecting them to continue to rise. So that means that many of our markets, particularly Sydney and Melbourne, have swung into favour of buyers. Some of our other mid-tier markets like Perth, Adelaide, Brisbane, they're slowing, but they're no way into a buyer's market like we're seeing in Sydney. So I do think it does depend on your personal circumstances. I think it's interesting some of the conversations that I've been having with agents around, these proposed changes to how we treat negative gearing and CGT discount. It's in the Senate at the moment. They're trying to rapidly pass it through before the beginning of July. If that does come through, it is going to have a marked impact and a structural change in our housing market that's really going to impact next financial year. But I think what we've started to see, though, is particularly that type of seller who is close to retirement, they've gone, right, I'm just cashing out now. Let's sell that investment property and let's get out before we know any potential taxational changes that come through. So it's very interesting how those potential changes to how we treat investment properties are already influencing people's behaviour.
Yeah, for sure. And I really liked your advice as well. I mean, it's often heard, and maybe it is a little bit boring to some people, but it is so true that you can't time these things with the property market. You can't pick the bottom. I mean, we've spoken to so many property experts and property investment gurus on this podcast, and even they have all admitted no one can pick the bottom. Like, we had one of the guys from Lux Listings, the reality show, one of the buyer's agents, Simon Cohen, and he was saying, look, if I could pick the bottom, I wouldn't be here right now talking to you. I'd be sitting on the beach somewhere with my mansion. No one can pick it. So yeah, certainly maybe it's a slightly different story when you're investing in property. You do want to get your timing right, but as someone just buying a place to live in, the time to buy is really when you find a place that you like and you can comfortably afford.
Absolutely.
So that's when I bought my place about 4 years ago. A lot of people were saying to me, no, it's a bad time right now. Probably interest rates are going up through the roof, and think property prices could be dropping about 20%. We just thought, we like this house. We haven't seen any others that we like, so we bought it and we haven't regretted it, and we love it. So
and look, one thing to remember is there is always going to be a floor to how far prices can actually fall. That floor comes from homeowners where they just don't sell when they think the price is far too low, but also we've still got construction pressure costs. So the cost to construct is still far higher than buying an established property. That dynamic in itself will continue to kind of create that floor for pricing.
Yeah, absolutely.
Yeah,
that's
it's great
point.
advice.
Yeah. Dr. Nicola Powell, really appreciate your time on the Savings Tip Jar podcast. Thanks for your insights.
Thanks for having me.
Thanks, Nicola.
That was Dr. Nicola Powell, Domain's Chief Residential Economist. And that brings us to the end of another episode of the Savings Tip Jar podcast, brought to you proudly by Savings.com.au, your home of Aussie savings news, guides, and financial product comparisons. If you like this episode, please give us a 5-star rating on Spotify, Apple, or whichever podcast platform you listen to. And if you want to get in touch, please send us an email to inquiries@savings.com.au. That's inquiries with an E. And we'll catch you next time. Thanks. Bye.